Hey guys, welcome back to another video, and in this video we're going to be uncovering the truth about share dilution. We're going to also have a look at what Warren Buffett has had to say in past annual shareholder letters and past annual meetings as well. So share issuing has a bit of a reputation for being a bad thing because it dilutes the percentage of ownership that each outstanding share represents. But as you'll find out in a second, it's actually not always a bad thing. And with that said, it often can be a bad thing, so I'm also going to show you what to watch out for and what to look for in order to help you from losing money in the stocks that you own and the stocks that you're thinking about buying. So first, here's what's meant by share dilution. Imagine there's a company that has a total of 100 shares outstanding. This would mean that each one of those 100 shares represents 1% of the company's ownership. So now we'll say that Bob here owns one share, so therefore he's a 1% owner of this company. And as a 1% owner, he literally owns 1% of that company's assets, but he also owns 1% of the company's liabilities, which is just another way of saying that he owns 1% of the company's equity. Now, he doesn't necessarily get to control and dictate what happens with that 1% of equity that he owns, but he does get to vote on what happens, and the strength of his vote will be dependent on his ownership percentage. And the exact same thing goes for the future earnings and cash that the company will generate. 1% of all the company's future earnings belong to Bob. However, again, Bob doesn't have direct control over what is done with those future earnings. So he cannot, for example, insist that his 1% is paid out to him as a dividend, although he will get 1% of any dividends that are paid out. All the shareholders collectively have control over the company, and one of the things they collectively decide on is who to put in charge as the CEO to make these decisions on their behalf, and hopefully with their best interests in mind. Nonetheless, let's say that the management of our hypothetical company with 100 shares decides that they want to raise some money to use for the purposes of reinvesting and growing the business. The management, and in particular the CEO, has a couple of options to get the money that they need. First, they could borrow the money from the bank and take on some debt. They could also issue something called preferred stock, which is quite similar to debt. Or they can issue some additional common shares. So let's say they decide to issue 10 new common shares in exchange for the cash they require. This would literally mean creating 10 new shares out of thin air and then selling them in exchange for the cash. Now, so there's a couple implications here. First, the company's total shares outstanding would now be 110. Second, each share no longer represents 1% of the company's ownership. If 100% of the ownership is now being divided up amongst 110 shares, then it means that each share now represents 0.909% of the company's ownership. So the ownership that each share represents has decreased. And so when people talk about share dilution, this is really what they're talking about right here. The percentage of ownership in the company that each share represents is being diluted. At first glance, it would seem that Bob should be unhappy. One day he owned 1% of the company and the next day he owned less. But that's actually not the full story. Because yes, Bob owns less of the company. However, with the ownership that he does still have, he now owns his percentage's worth of the cash that the company received from issuing those 10 new shares as well. And he's gonna own his ownership percentage's worth of whatever that cash will end up being used to buy. So to really know whether this was actually a negative experience or in fact a positive experience, we actually need some more information. First, how much cash was received for those 10 new shares that were issued? And more importantly, what was the value of those 10 shares that were given up in exchange for that cash? And then secondly, how did the company end up using that new cash? And particularly, what is the value of what the company has purchased with it? And so as you can see, value is the big determining factor. And as you'll see in a second, price and value are not always one and the same. So let's look at our example company again for a second, and let's go back to before the 10 new shares were issued. And let's put a value on this company. Let's say that the whole company is worth $1 million, which means that each one of the 100 shares is worth $10,000, because a $1 million total value divided by 100 shares is $10,000 per share. So Bob's one share is worth $10,000. But now here's where the tricky part comes in, which can make this whole thing possibly confusing, but it's also at the core of what all of investing is based around. Here it is. A company's value and a company's market price are often not one and the same thing. And as Warren Buffett puts it in his 1994 letter to shareholders, he says, "We define intrinsic value as the discounted value of the cash that can be taken out of the business during its remaining life. Anyone calculating intrinsic value necessarily comes up with a highly subjective figure that will change both as estimates of future cash flows are revised and as interest rates move. Despite its fuzziness, however, intrinsic value is all important and is the only logical way to evaluate the relative attractiveness of investments in businesses." See, Warren Buffett has said that him and his partner Charlie Munger could both independently calculate the value of Berkshire Hathaway, and they would both come up with two different numbers, although they would likely be pretty close. And on top of that, the quoted market price of Berkshire Hathaway could still be different as well, and it often is. And often the difference between price and value can sometimes even be extreme, depending on how excited and optimistic or how scared and depressed investors are as a collective. So we said that our hypothetical company with 100 shares is worth $1 million, which means that each one of the 100 shares is worth $10,000. So if the company sells 10 new shares using that $1 million valuation, it will receive $100,000 from selling those 10 new shares. This means that the company as a whole would now be worth the $1 million plus the $100,000 of cash that it now has, for a total value of $1,100,000. Now, on a per share basis, let's look how Bob's situation has changed. Since the number of total shares outstanding is now 110, his one share represents 0.909% of the company's ownership. And if we were to take the new value of $1,100,000 and multiply it by the percentage amount that Bob owns, we'll find that the value of his ownership is actually still $10,000. So Bob is actually no better or worse off than he was before the company issued the new shares. His ownership percentage was diluted, but the value of his ownership was not. Now, as you could imagine, if the company sold the 10 new shares for less than they were worth, then Bob would be worse off. And likewise, if the company managed to sell those 10 shares for more than they were worth, he would actually be better off than he was before, even though his ownership percentage has decreased. Okay, now I'm going to play a little clip of Warren Buffett speaking on this subject, and to give some context to what you're about to see, someone has essentially asked him, hey, is it not better for Berkshire to make business acquisitions using cash instead of using stock so that the current shareholders won't have their ownership diluted? And Buffett's answer is essentially that even if they did use cash to make the purchase, the shareholders' value can still be diluted if the value of what they've purchased is less than the cash being exchanged for it, even if no shares are issued. Check it out and then watch what he says right after.
If we give $200 million of cash for a business that's worth $150 million, we are worse off. We may not have issued a share of stock, but we have diluted the value of your stock if we do that. As long as we get value received, in terms of whether of cash, common stock, or preferred stock, then you are not diluted in terms of value. It's an important point. And obviously a number of companies, as you may have, Charlie and I have commented about in reports and elsewhere, a number of companies, in our opinion, have issued common stock, particularly, which has a value greater than what they receive. And when they do that, they are running what John Medlin of the Wachovia called a chain letter in reverse. And that's cost American shareholders a lot of money. I don't think it'll cost them any money at Berkshire, but it's a perfectly valid worry for shareholders to have, because a management can build an empire just by issuing these little pieces of paper, which they feel don't cost them anything.
So what Warren Buffett is saying at the end there is that it's really not uncommon for the management of businesses to think of issuing shares as kind of like getting free money, and to not fully respect the value of what is being given up when they issue new shares. See, public companies can and often do use their stock as sort of like an alternative currency to acquire other businesses with. And just like how smart investors seek to buy stocks when the market is pricing them below what they're currently worth, the savvy CEOs of the world who are focused on shareholder returns and maximizing per share intrinsic value for their shareholders also seek to take advantage of the stock market in the same way, particularly by using their stock as a currency when it's being overpriced by the market, and then later use the company's cash to buy back their stock on the open market when it's being underpriced by the market. The bad CEOs, who, by the way, aren't necessarily bad at managing the operations of the company, either don't get it or don't care. As Buffett said, the management of a company could build an empire for themselves by continually issuing new stock, but that empire would be getting built for the management and at the expense of the shareholders rather than to the shareholders' benefit. So it's both the value of what's being given up and the value of what's being received in exchange that matter. Sometimes the CEO of a company can also be a shareholder themselves, which often means their goals will naturally be aligned with your goals as a fellow shareholder. Now, as a caveat to that point, sometimes newer businesses that have recently went public can have founder CEOs who own a significant portion of the company, but who are also just focused on trying to cash out as fast as possible. And so if you see this, that's going to be a bit of a red flag to watch out for. But besides that, generally, if a CEO owns a significant portion of the business, and it especially goes for when a significant portion of their net worth is made up of shares in that company, then it's going to be a good sign that the management and the shareholders are going to be aligned. And when you see that a CEO doesn't own any shares of the company, well, then it means that there's a much higher chance for there to be a misalignment of priorities. Now, going back to Warren Buffett's 1994 shareholder letter, he puts it like this: understanding intrinsic value is as important for managers as it is for investors. When managers are making capital allocation decisions, including decisions to repurchase shares, it's vital that they act in ways that increase per share intrinsic value and avoid moves that decrease it. This principle may seem obvious, but we constantly see it violated. And when miscalculations occur, shareholders are hurt. For example, in contemplating business mergers and acquisitions, many managers tend to focus on whether the transaction is immediately dilutive or anti-dilutive to earnings per share, or at financial institutions, per share book value. An emphasis of this sort carries great dangers. Going back to our college education example, imagine that a 25-year-old first-year MBA student is considering merging his future economic interests with those of a 25-year-old day laborer. The MBA student, a non-earner, would find that a share-for-share merger of his equity interests in himself with that of the day laborer would enhance his near-term earnings in a big way. But what could be sillier for the student than a deal of this kind? Does that make sense? And can you see how it's possible for a CEO to make a bad capital allocation decision, especially if they're only focusing on increasing next year's earnings per share rather than being focused on per share intrinsic value? So when it comes to a company issuing shares or making acquisitions using shares, it's not so important whether your ownership percentage is being diluted or not, but rather what's more important is whether the value of your ownership is being diluted. So here's what you're going to want to look out for. 1, does the CEO own a decent chunk of the shares and therefore have a vested interest in maximizing shareholder value? 2, letters to shareholders can often give strong clues as to the CEO's priorities. 3, you can look at past acquisitions and try to come to your own conclusion on whether it was a good deal or not, considering both the value that was gained and the value that was exchanged. 4, also just simply noticing if the company in question consistently generates high returns on invested capital, in addition to, at the same time, consistently returning a lot of that cash it generates back to the shareholders through dividends and through share repurchases. And then 5, take a look at how the shares outstanding count has changed over time and try to get a sense of whether or not the shares are being issued and repurchased at moments that it makes sense to do so.
When we acquire businesses, sometimes the seller of the business wants cash, sometimes they would like common stock, and it's certainly possible, as one potential seller did last year, that they wanted, in that case, a convertible preferred stock. Now, from our standpoint, as long as the value of the consideration that we give equates, we really don't care, aside from a question of tax basis we might obtain, but we, in other economic respects, we don't care what form of consideration we use, because we will equate the value of cash versus a straight preferred versus a convertible preferred versus common stock, whatever it may be. We have no feeling that we're getting richer when we issue shares. We have a feeling we're getting richer when we get at least as much value in a business as the shares are worth that we issue. And we don't intend to issue them under any other circumstances, but it's a perfectly valid worry.